Welcome to the Opening Bell Report.
We've got a really interesting one today. It feels less like a typical financial report and more like a mystery.
It is a total disconnect.
Right. The clues just don't seem to add up. We're looking at a company where the numbers on the page and the price on the ticker, they just don't match.
A complete mismatch between what it's worth and what it's selling for.
Yeah, you've got Wall Street analysts, and the report quotes this screaming buy. You see these price targets suggesting the stock could double.
Maybe even more.
And yet, if you look at the market, it's treating this company like it's almost invisible.
It's a fascinating setup. We're digging into an analysis on Digital, that's ticker BTBT. And if you just pull up the chart right now, you're not going to see fireworks.
Not at all.
It's trading around, what, $2.37? It's been bouncing along this floor of about $2.29. It looks sleepy.
Very sleepy. A small cap stock trading for what the report calls pennies on the dollar. But then you open this analysis and the headline is practically shouting, strong buy, 100% upside.
Massive breakout alert.
So our mission for this deep dive is pretty straightforward. We need to figure out who's wrong here. Is the market missing something huge, or is this report just too good to be true?
That's the core tension. You have a stock stuck in the $2 range, and you have analysts predicting $5 or higher.
Right.
So why? What's in this report that makes them so confident?
The report uses two terms that jumped out at me right away.
Yeah.
Deep value and contrarian opportunity.
Which is really the heart of the argument, and it frames it very specifically. It calls Digital an AI infrastructure play disguised as a crypto miner.
A disguise. I love that. It implies the market is just looking at the label, not what's inside. But before we get to the AI part, which is the exciting part of the story, we have to talk about that deep value argument.
We do.
Because honestly, when I saw the numbers in this report, I thought it might be a typo.
They are startling. The report really builds its case on two main valuation metrics. First, let's just look at the price-to-earnings ratio, the PE.
Okay.
Digital is sitting at a PE of 6.02.
Let's put that in context. For anything in tech, especially anything near AI or data centers, you see PEs in the 30s, 50s. I mean, look at NVIDIA.
They're in the stratosphere.
Right. A PE of 6 is usually for like a shrinking industry, something people expect to decline.
Exactly. It's bargain basement. But the number the report really leans into is the price-to-book ratio, or PB.
And that one is 0.86.
0.86.
Okay, let's pause and unpack that. Most people get PE, but price-to-book can be a little more abstract. If a company's PB is under 1, what is the market actually saying about it?
It's a very significant and pretty rare signal. So book value is essentially the net asset value. You take everything the company owns, cash, Bitcoin, servers, and you subtract everything they own.
The sum of its parts.
Exactly. If a company trades at a PB of 1.0, the market is saying, you're worth exactly what's on your balance sheet.
Makes sense.
But when it trades at 0.86, the market is saying, we think this company is worth less than the actual hard assets it owns.
That just sounds irrational. It's like seeing someone selling a dollar bill for 86 cents. Why wouldn't you just buy that all day long?
You would. But markets aren't always rational. Usually when you see a PB this low, it's a distress signal. Investors think a disaster is coming.
They're saying, we don't believe you actually get to keep that money.
Precisely. But this is where the report gets aggressive with what it calls the liquidation theory.
I saw that. It's a great way to visualize it.
The report says, imagine Digital just closes its doors today, they fire everyone, shut it all down, then they sell everything.
A complete fire sale.
Every Bitcoin, every GPU, all of it. They pay off every single debt. The report calculates that the cash left over for shareholders would actually be more than the current share price of $237.
That's wild. So I'm essentially buying a basket of cash and assets for a discount.
That is the literal definition of deep value.
Yeah.
The report says the market is pricing BTBT like it's going bankrupt. But then it points to the numbers.
And that's the other shoe. Is there a fire? Because where there's smoke.
Well, according to this analysis, there is no fire. It's the opposite. They reported $146 million in net income. They have huge cash reserves. The report calls it a fortress balance sheet.
A fortress balance sheet? You don't use that term for a company about to go under?
No. So you have this huge disconnect. The stock price says distress, but the balance sheet says fortress.
So why? If the financials are solid, why does the market hate it? Is it just because it's a Bitcoin miner?
And that takes us to the catalyst. The problem isn't the reality, it's the perception. For a long time, Digital was just another Bitcoin miner.
And we know that story. Bitcoin goes up, miners go up, Bitcoin goes down.
They get crushed. It's a roller coaster. The correlation is historically very tight. The trading algorithms just see it as a proxy for BTC.
Right.
But the report argues that this view is now outdated. It says, and I'm quoting, if you think BTBT drops just because Bitcoin drops, you are wrong.
They put that in all caps, didn't they?
Well, they did, because the narrative has completely changed. BitDigital isn't just mining crypto anymore. They are making a massive pivot into AI.
This is the high-performance computing, or HPC, angle. But I have to be the skeptic here. It feels like every company in 2024 is trying to say they're an AI company. Is this real, or is it just buzzwords?
That's a healthy skepticism. There's a lot of AI washing going on. But in this case, the report details that it's a genuine HPC build-out. They're taking those powerful GPUs.
The graphics cards.
Right. And instead of just using them to mine Bitcoin, they're renting them out for AI processing.
So they're basically becoming a landlord for AI compute power.
Perfect analogy. And think about the economics of that. Mining is speculative. You hope you find a block. You hope the price is high. It's volatile.
You have zero control over the price of what you're making.
But renting out GPUs for AI, that's a contract. It's stable, recurring revenue. It's boring, reliable cash flow.
Boring in the best possible way. The rent check clears no matter what Bitcoin did today.
Correct. And the report notes this revenue stream is skyrocketing year over year. Their AI fleet is fully operational now. This isn't a plan for 2027.
And that brings us back to that great quote, an AI infrastructure play disguised as a crypto miner.
It's a powerful way to frame it. The market sees an old miner and gives it a low PE. The report sees a new AI company and realizes it's completely mispriced.
But changing that perception takes time. The market has inertia.
It does. But that's why the report is highlighting it now. They're trying to get in before the turn. If you wait until everyone agrees, the stock's already at $10.
Let's talk about the analysts, because if this is just one opinion, I'm skeptical.
It's not. The report points to external validation. There are 4 major analysts covering the stock. All 4 rated a strong guy.
Unanimous.
Yep. No holds, no sells. That's rare.
And what are the price targets?
The average is between 513 and 550.
Okay, so from 237 to, say, 550.
That's more than a double. Over 100% upside.
And they ground that in the earnings, right?
They do. They point to the earnings per share, the EPS. It's 47 cents.
47 cents of profit per share.
Right. Now compare that to a $2.30 share price. The report says the math doesn't add up. If you applied even a modest tech multiple of, say, 15 to that.
You're at a stock price around $7.
Exactly. Even a conservative multiple gets you well past 5. The report says when the math is this broken, it's a buying opportunity. Their advice is blunt. Buy the dip.
All right, so we've got the fundamental value, the AI growth story. But what about the timing? The report goes into the technicals of why now is the moment.
Right. The technicals are about the when. The report identifies a very clear structure on the price chart.
It talks about a floor and a ceiling.
The floor is right where we are, that 220 to 230 level. The stock just bounced hard off 229. That suggests strong buyers are there.
That's your safety net. That's probably the book value buyer stepping in.
Exactly. And then you have the ceiling or immediate resistance at $2.44.
Just a few cents away.
It's the first hurdle. And the report argues if it can break through that level with some real volume, it could trigger what's called a gap fill.
Explain gap fill for us.
Sure. Sometimes the stock drops so fast it skips price levels. It goes from $3 straight down to $2.50, leaving a gap on the chart.
A vacuum.
Yes. And theory says the price tends to race back up to fill that vacuum because there's not much resistance there. The report sees a clear path to $3 if it breaks $2.44.
And the ultimate target.
A retest of the 52-week highs near $4.55.
So we have a roadmap. Bounce off the 230 floor, break the 244 ceiling, run to 3, then climb toward 450.
That's the path. And this all leads to the risk-to-reward ratio, which the report calls insane.
Insane good, I'm assuming.
Insane good. Look at the math. If the floor is at 220 and you buy at 237, you're risking about 17 cents of downside.
Okay, that's what I lose if I'm wrong.
But if you're right and it goes to $4.55 or $5, you're looking at over $2.50 of upside.
So I'm risking a quarter to make $2.50.
It's a 10-to-1 risk reward. Traders dream of finding 3-to-1 setups. A 10-to-1 backed by these fundamentals is incredibly rare.
It definitely puts that strong buy into perspective, but we have to be careful. Support levels can break.
Of course. If the whole market panics, all bets are off. Panic doesn't care about PB ratios.
But assuming things hold steady, that combination of deep value and the technical setup it's pretty compelling.
It is.
I want to circle back, though. The report says the market is sleeping on the AI revenue.
Yes.
Why? In this market, AI is the only thing anyone talks about. How does a company with skyrocketing AI revenue get ignored?
It's what you could call label bias. BitDigital has been in the crypto miner bucket for years.
So the algorithms just see the ticker and think, Bitcoin proxy.
That's it, exactly.
Yeah.
And to get the market to move it from the crypto bucket to the data center bucket takes a shock to the system.
And that shock would be?
Earnings reports. The report suggests the next one could be the wake-up call. Once it's official that, say, 40% of their revenue is now stable, recurring AI contracts, You can't ignore it.
The numbers force the narrative to change.
Right. You can argue about the story, but you can't argue with the cash flow.
Yeah.
By the time that's a headline, the 230 price will be long gone.
Okay, so let's try to summarize the whole case. The elevator pitch for our listener. What is it?
I'd say it's 4 pillars. Pillar 1, deep value, trading below its liquidation value with a fortress balance sheet, a margin of safety.
Got it. Worth more dead than alive.
Pillar 2, the pivot, a successful shift to stable, high-growth AI infrastructure. It improves the quality of their earnings.
Pillar 3.
Consensus, unanimous strong buy from all covering analysts with targets for 100% upside.
And the last one.
The setup, you're at a technical floor with a risk-reward that's just massively skewed in your favor.
It really is a powerful argument when you stack it all up like that. It just paints a picture of a company that's deeply misunderstood.
It's a classic contrarian play.
Yeah.
You're betting against the crowd because you think you see the reality more clearly.
And that reality is AI.
It's always AI these days, isn't it?
What?
But here it's tangible. It's hardware. It's not some software that might work in 5 years.
So as we wrap this up, the question for the listener really comes down to conviction.
That's the so what here. If you believe this report, the market is offering you $1 for 86 cents just because it's confused.
And the report ends with that pretty direct call to action. Are you loading the boat now, or are you waiting for the price to jump first?
It's a challenge. It's psychologically tough to buy a stock that's just sitting there.
Yeah.
It feels dead.
Yeah.
But the report argues that's exactly when you should be buying.
You know, this whole thing leaves me with one final thought. We spend so much time chasing the hot stocks, the ones already hitting all-time highs.
The ones priced for perfection.
Right. You pay a premium for that hype. But maybe in a market this obsessed with AI, the best opportunities aren't the obvious ones. Maybe they're the ones hiding in plain sight.
Wearing a disguise.
Exactly. It makes you wonder how many other AI plays are out there masquerading as something boring that the market has already written off.
That's a very provocative question. It forces you to look beneath the labels.
Thanks for joining us for this look at Bit Digital. It has certainly given me a lot to think about.
My pleasure. It was a fascinating one to unpack.
Don't forget to like, share, and subscribe for more.